Friends, do you know that the biggest secret in the stock market is not just making money, but protecting your money? Today, we are going to talk about Benjamin Graham's timeless classic, The Intelligent Investor, which is considered the Bible for every investor in the investing world. In this video, we will understand how to choose safe and profitable investments, why the margin of safety is the most important principle, and how even an ordinary investor can make smart decisions in the market. If you want your money to work for you and avoid the deceptive fluctuations of the market, then this video is for you. Let's get started and learn how an ordinary investor can also become an intelligent investor. Chapter 1. What is investing and what is speculation? Friends, do you know that most people who enter the stock market are not really investing? They are speculating? This is the first thing Benjamin Graham, one of the greatest investors in the world, teaches us. What is real investing? Graham says an investment requires three things. 1. Protection of your principal. 2. A reasonable expectation of return. 3. And thorough analysis. If any of these are missing, it is not an investment but speculation. Investor versus speculator. An investor acts wisely, minimizes risk, and thinks long-term. A speculator, on the other hand, seeks huge short-term gains, even if it risks losing their money. Graham says that an intelligent investor invests with their mind, not their emotions. They maintain a balance between fear and greed. The story of Mr. Market. Graham introduces a fascinating concept called Mr. Market. He says, think of the stock market as a person who comes to your door daily and offers to buy or sell your shares. Sometimes he's extremely excited and offers high prices, and sometimes he's depressed and wants to sell at very low prices. The smart approach is, don't react to his mood. Instead, act only when the difference between price and value gives you an advantage. Summary. In this chapter, Graham teaches us that to win in the stock market, you must be smarter than the market. Invest with logic, patience, and discipline, not based on rumors or short-term excitement. If the market changes every day, how does an intelligent investor decide when to buy and when not to? Benjamin Graham answers this wisely in the next chapter. Chapter 2. The Investor and Inflation. Have you ever noticed that the value of your money decreases every year? What you buy for $1,000 today may cost $1,500 or $2,000 in 5 years. This is inflation. Benjamin Graham explains that an intelligent investor should focus not only on earning money, but also on preserving its real purchasing power. How does inflation affect money? Graham says that if you keep $100,000 in a safe place, like a bank or in cash, after a few years, the nominal amount remains the same, but its real value, or purchasing power, decreases. Example. In 1970, you could buy a scooter for $10,000, but today, $10,000 might only cover fuel. The value of money decreases. This is the effect of inflation. Are cash and bonds safe? Many believe that fixed deposits, savings accounts, or government bonds are the safest. But Graham says this is the most dangerous safety, because the fixed returns from these cannot beat inflation. You earn nominally, but your money's real power decreases over time. Can stocks protect against inflation? Graham points out that investing in stocks can help fight inflation, because companies can raise prices, increase profits, and over time, their stock prices rise. But he warns, the stock market is not a perfect protection against inflation. Short-term market fluctuations are unpredictable. What should an intelligent investor do? Graham advises understanding two things. 1. Inflation always exists, so don't just save, invest. 2. Diversify your investments, put some in equity, some in bonds, and some in cash, so you can survive any economic situation. Summary. Inflation is a silent killer that reduces your money's power without notice. An intelligent investor should focus on real returns, not just nominal returns. If stocks are essential to fight inflation, which stocks are safe and which are risky? Benjamin Graham answers this in the next chapter with a new concept. Chapter 3. A Century of Stock Market History. Do you think today's stock market is very unpredictable? Now think about the past 100 years. How many times has it gone up and how many times has it fallen? Benjamin Graham says that if you don't know history, the market will fool you every time. Market fluctuations tell human stories. Graham explains that the stock market isn't just about numbers. It reflects human emotions, fear, greed, and hope. Looking at market data from 1900 to 1970, he notes that every time people thought profits will always continue, the market hit them hard. And when people ran away in fear, the real opportunities were hidden. Markets always rise, but not in a straight line. Graham writes, over the long term, markets always rise, but the path is never straight. Sometimes comes the Great Depression, 1929. Sometimes world wars, oil crises, each time the market drops but slowly recovers. So if you are a long-term investor, declines aren't frightening, they are opportunities to buy. Be an investor, not a speculator. Here, Graham differentiates between investor and speculator. An investor becomes a part owner of a company, understands its business, and holds it long term. A speculator chases short-term prices, guesses, and ends up losing. Graham says speculation isn't a sin, but mistaking it for investment is the biggest mistake. Lessons from history. History teaches us, no market always goes up. Selling in panic is the biggest mistake. The patient investor earns real profits. According to Graham, an intelligent investor doesn't fight the market. They use the market's moods to their advantage. Summary. The main lesson from this chapter is, the stock market tests your emotions. If you can control greed and fear, history becomes your best teacher. If the market is so unpredictable, how do you decide which investment is safe and which is risky? Benjamin Graham answers this in the next chapter through the secrets of the defensive investor. Chapter 4. Investment approach for the defensive investor. Are you someone who gets scared by the daily ups and downs of the stock market? Who wants their money to remain safe, whether the market rises or falls? Benjamin Graham says you are a defensive investor. Who is a defensive investor? According to Graham, a defensive investor is busy with their job or business, is not a stock market expert, and doesn't want to take too much risk. They want their money to grow steadily and safely, without much stress. Graham says, anyone can become an intelligent investor, but not everyone needs to be aggressive. Balancing investments, equity and bonds. Graham gives a simple formula for the defensive investor. 50% stocks, 50% bonds. This keeps the portfolio balanced. If the market drops, bonds provide stability. If the market rises, stocks provide growth. He advises, never put more than 75% in one asset and never less than 25% in another. This balance is the key to long-term security. 4 rules for defensive investors. 1. Buy high-quality companies. Choose companies with consistent profits for years. 2. Diversify. Invest in 10 to 30 strong companies to reduce risk. 3. Avoid speculation. Stay away from short-term trading or rumor-based buying. 4. Keep it simple. Choose simple index funds or mutual funds instead of complex strategies. Real-world example. Suppose you invest $100,000, $50,000 in bonds, $50,000 in stocks. If stocks fall to $40,000, you can rebalance to 50-50. This allows you to buy cheaply during declines. Your fear becomes your strength. Graham's golden lesson. Benjamin Graham writes, the goal of a defensive investor is not greed but avoiding mistakes. An intelligent investor protects themselves first, then seeks profit. Summary. Defensive investing may seem boring, but it works best in the long run. It protects you from market madness and gradually grows your wealth. If the defensive investor's job is to protect their money, who takes higher risks for higher returns? Benjamin Graham answers this in the next chapter, explaining the mindset and strategy of the aggressive investor. Chapter 5. Strategy of the enterprising, aggressive investor. What if I told you that you can earn higher returns from the market, but in return you'll need extra effort, patience, and intelligence? Are you ready? Benjamin Graham says that an investor willing to put in extra effort to grow their money is called an enterprising or aggressive investor. Difference between defensive and enterprising investors. Defensive investors seek safety, while enterprising investors seek performance. The difference isn't just risk, it's effort and discipline. Enterprising investors require deep research, understanding of company financial statements, and patience to avoid short-term noise. 4 ways for enterprising investors. Benjamin Graham outlines 4 practical ways for an enterprising investor to earn higher returns. 1. Undervalued stocks, bargain stocks, companies trading below their intrinsic value. Example, a company worth $100 is trading at $60, a bargain opportunity. 2. Special situations. During mergers, acquisitions, or restructuring, some stocks become undervalued. Smart research can yield big gains. 3. Neglected stocks. Sometimes the best opportunities are unnoticed, small companies that are financially strong. 4. Avoid short-term trading. Being enterprising doesn't mean buying and selling daily. Graham warns, the line between speculation and intelligent investing is thin. Don't cross it. Real example. A company's book value is $200, but it trades at $120. If you remain patient until the market recognizes its value, you could earn 60 to 70% returns. Graham's master rule. The real advantage of an enterprising investor is buying cheap and waiting, not predicting the market daily. Key difference summary. Aspect. Defensive investor. Enterprising investor. Goal. Safety. Growth. Time. Minimal. More effort and time. Risk. Low. Moderate. Approach. Passive. Active. Summary. Graham says everyone should first ask, am I defensive or enterprising? Your success depends on your personality and patience, not market predictions. If an enterprising investor works harder, which companies or industries should they focus on for real bargains? Benjamin Graham answers this in the next chapter. Chapter 6. Strategic Portfolio for the Enterprising Investor. The real investor doesn't jump at every market movement. They invest in the right place, at the right time. Benjamin Graham explains how an enterprising investor should structure their portfolio to earn higher returns while controlling risk. Key insights. Higher market returns don't mean higher risk. They mean more intelligence and discipline, says Graham. Enterprising investors shouldn't blindly buy stocks. They must identify undervalued assets versus hype. Step 1. Choose the right stocks. 4 categories Graham suggests for enterprising investors. 1. Undervalued large companies. Big, famous companies temporarily undervalued. 2. Small but strong companies. Smaller firms making profits but unnoticed, hidden gems. 3. Special situations/workouts. Companies in mergers, restructuring, or temporary trouble. Opportunities for smart investors. 4. Cyclical stocks. Companies that follow the economy. Buy low, sell high. Step 2. Portfolio allocation. Don't concentrate money in one place. Diversification is your safety net. Suggested allocation. 25% bonds. 75% stocks across sectors. This controls risk and increases growth potential. Step 3. Avoid overconfidence. Graham warns, don't be so confident that you try to outsmart the market. Overconfidence leads to overtrading and losses. Classic rule. Market gives opportunities daily, but not every opportunity is yours. Real-life example. A company's stock drops from $1,000 to $650 due to market panic, but earnings and fundamentals remain strong. This is a smart buying opportunity. Summary. An enterprising investor doesn't predict the market. They prepare for it. A smart portfolio stays steady in falling markets and grows in rising markets. If an enterprising investor knows which stocks are undervalued, how do they decide which to avoid and which are value traps? Benjamin Graham answers in the next chapter. Chapter 7. Margin of Safety. The Golden Rule of Safe Investing. Benjamin Graham says the margin of safety is not just a strategy, it's a shield for every intelligent investor. It means always buying a stock when its market price is significantly below its intrinsic value. This margin protects you from mistakes, fear, and market fluctuations. Example: a company's true value is $100, but it trades at $70. Buying it gives you a $30 margin of safety. Even if the market dips, your loss is limited, and your gains will be high when prices rise. Graham says avoiding stupidity in investing is more important than chasing profit. How to identify margin of safety? 1. Estimate the company's true value by analyzing earnings, assets, and future growth. 2. Compare it to market price. Invest only if the price is significantly lower. 3. Don't assume every falling stock is cheap. Understand its intrinsic value, not emotions. Real-life logic. Buying a $100 item for $60 reduces risk. Same in investing. Buy cheap, think deep. Graham emphasizes margin of safety as the principle that protects you from market madness. Warren Buffett considers this one of his greatest lessons. Next question: how do we determine a company's intrinsic value? Which signals indicate a stock is overvalued or undervalued? We'll learn this in the next chapter. Chapter 8. The Investor and Market Fluctuations, Befriending Market Ups and Downs. Benjamin Graham teaches, the stock market is not your enemy, it's your servant. Mr. Market's story. Graham describes the market as a person, Mr. Market. He comes daily to your door saying, "Hey, I want to buy your company share at $200. The next day, "No, now it's only $100. Sometimes he's happy, sometimes scared. Graham advises thinking with your mind, not reacting to Mr. Market's moods. Buy when he's sad and selling cheap, sell when he's crazy and overpriced. Investor versus speculator. Dancing to the market's mood makes you a speculator, not an investor. Investors focus on company value. Speculators follow noise. The wise investor turns market madness to their advantage. True meaning of buy low, sell high. It's not magic. When everyone is fearful, the market is down. That's the opportunity. When everyone is greedy, it's time to step back. Be fearful when others are greedy, and greedy when others are fearful. Warren Buffett's quote inspired by this chapter. Control your emotions. Graham says, your biggest enemy is not the market, it's your fear and greed. Those who control their emotions survive long-term in the market. Lesson: understand the market mood, but don't become its slave. Now think, if we don't follow Mr. Market's mood, then based on what should we invest? Which signals show a company is genuinely strong and not just pretending? The answer will be revealed in the next chapter. Chapter 9. Investing in investment funds. Is investing in mutual funds smart or a trap? Friends, in this chapter, Benjamin Graham answers a very common question. If I don't know how to pick individual stocks, is it right to invest in mutual funds? In other words, is it okay to trust someone else with your money or not? Let's understand the essence of this chapter. What do mutual funds do? Graham explains that mutual funds, also called investment funds, essentially pool your money together and invest it in multiple companies. This reduces your risk a bit because your money is spread across many places instead of being concentrated in one. But while this is convenient, it can also be dangerous. Fund managers are human too. Graham points out that many people assume fund managers are experts who can always beat the market. But the truth is, most funds underperform the market index over the long term. Why? Because of high fees, emotional decisions, and overtrading. Graham says, the safety of your money is determined by your mind, not someone else's. Low-cost index funds, the smart way. Benjamin Graham highly praises index funds because they offer two major advantages. 1. Low cost. 2. Market average returns. He says that if you are a passive investor, index funds are perfect for you because you grow with the market average without chasing any expert. Rules for choosing a fund. If you still want to invest in mutual funds, Graham gives some golden rules. Look for consistent performance over the past 10 years. Compare fees and expense ratios. Always take a long-term view. Don't chase short-term trends. Most importantly, avoid popular funds because crowded funds tend to fall quickly. Discipline is the real power. Graham says investment funds are only beneficial if you invest in them with discipline. This means a systematic investment plan, SIP, putting in a little money every month, because consistency, not a one-night jackpot, makes you wealthy. So friends, the takeaway from this chapter is, investing in mutual funds isn't bad, but uninformed investment is dangerous. Now think, if even mutual funds require using your brain, then what can really be called a safe investment? How do you know if an investment is safe or a trap? Benjamin Graham reveals this secret in the next chapter. Chapter 10. The Investor and His Advisors. Who should you trust? Friends, in this chapter, Benjamin Graham answers a very important question. Should I make my investment decisions myself or seek help from a financial advisor? Every investor asks this at some point. Let's see what Graham says. Listen to advice, but don't follow blindly. Graham says, getting advice isn't wrong, but blind trust is the biggest mistake. Many people make bad investments by following brokers, agents, or so-called experts. Remember, most of them earn from your money, not for your benefit. Their profit is often more important than yours. True advisor versus salesman. Graham distinguishes between two types of advisors. 1. Salesman advisor gives advice just to sell, whether mutual funds, insurance, or stocks. Their real aim is to earn commission, not guide you. 2. True financial advisor. Honest advice based on your goals, risk tolerance, and financial situation. They may even say no when everyone else says yes. Graham says a true advisor is one who says no even when everyone else says yes. Questions to ask an advisor. Graham suggests practical questions. What is your experience? Have you personally invested in these products? What are your fees? And how do you earn commissions? If I lose money, what responsibility will you take? These questions quickly reveal whether an advisor is genuine or just a salesman. Education is the real advisor. Graham emphasizes, an educated investor never relies blindly on anyone. If you have financial knowledge, no one can fool you. Advisor guidance only works when you are informed. Independent thinking is power. He says a smart investor listens to others but makes decisions based on their own logic and research. In the end, it's your money, so the responsibility is yours. The main message of this chapter: seek advice, but think, learn, and act wisely. Because in investing, blind trust is the biggest mistake. Now think, if trusting others is risky, is there a way to make investment decisions with 100% confidence? Benjamin Graham reveals this in the next chapter. Chapter 11. Security Analysis for the Lay Investor. Safe Investing for the Average Investor. Friends, in this chapter, Graham explains how a normal investor, lay investor, can protect their money without becoming a big expert. What is security analysis? Security analysis means studying a company's financial statements, assets, earnings, and future potential to determine if its stock is safe or risky. Graham says every investor should know where their money is going and how much safety, margin of safety, they have. Simple methods for lay investors. Graham offers principles that help normal investors invest safely and intelligently. 1. Pick strong companies. High earning stability. Low debt. Consistent dividends. 2. Diversification. Spread money across 10 to 30 good companies so one company's drop doesn't hurt your portfolio. 3. Understand market price versus intrinsic value. Buy undervalued stocks. Avoid overvalued stocks. 4. Think long-term. Don't panic at short-term fluctuations. Patience is the real weapon. Real-life example. If a company has assets worth 10 million rupees, but the stock market values it at 6 million rupees, buying it gives a cushion, margin of safety. Even if the market falls temporarily, your risk is lower. Graham's golden advice. Lay investors don't need elaborate analysis. Strong companies, diversification, and margin of safety are enough. That is intelligence. So a lay investor can safely invest in the market by being disciplined and sensible. If a lay investor can safely invest using such simple methods, can they also benefit from aggressive investor strategies? Or are there different rules for them? Next chapter answers this with Graham's expert tips. Chapter 12. Things to consider about per-share earnings, EPS. Friends, Graham explains what investors should consider when analyzing a company's per-share earnings, EPS. What is EPS and why does it matter? EPS, earnings per share, tells how much profit a company earned per share. Graham says company earnings are not just numbers, they indicate if a company is fundamentally strong. 3 golden rules for analyzing EPS. 1. Consistency over spikes. Don't assume a 1-year high earning will continue. Look at a 10-year average. 2. Adjust for extraordinary items. Ignore one-time profits or losses like asset sales or settlements. Focus on real business earnings. 3. Don't overestimate growth. Past growth is useful, but assuming future growth blindly is risky. Conservative estimates are intelligent investing. Watch price earnings, PE ratio. EPS is meaningful only in context of price. High PE right-pointing arrow market optimistic. Low PE right-pointing arrow possibly undervalued. But relying only on PE is wrong. Check assets, debt, and business model too. Real-life example. Company A averaged EPS of 50 rupees over 10 years. This year, EPS equals 120 rupees due to office sale. If you invest based on 120 rupees alone, you may overpay. 10-year average gives a better perspective. Graham's golden advice. EPS is useful, but don't rely on it alone. Consider history, extraordinary items, and realistic growth. Chapter 13. A comparison of 4 listed companies. Friends, Graham explains with practical examples how an investor can make intelligent investment choices. Why compare 4 companies? Theory alone doesn't teach investors. Real examples show which company is undervalued, which is overvalued, which only looks good. 4 categories of companies. 1. Strong, consistent, stable earnings, low debt, good for long-term growth. 2. Cyclical. Earnings fluctuate with economy. Boom equals good, recession equals risky. 3. Speculative. High risk, volatile, only for aggressive investors. 4. Declining, weak fundamentals, avoid. Key lessons. Diversify. Focus on fundamentals. Think long-term. Understand value versus price. Real-life insight. 2 companies with the same market value may differ in fundamentals. One safe, one risky. Market price doesn't always reflect reality. Graham's golden advice. Investment decisions should be based on real numbers and company health, not popular opinion or market trends. Chapter 14. Stock selection for the defensive investor. Friends, Graham explains how a defensive, conservative investor should choose stocks. Defensive investor mindset. Goal: preserve capital and earn moderate returns, not beat the market. Strategy should be simple and disciplined. Rules for defensive investors. 1. Large, strong companies with consistent earnings and low debt. 2. Diversification across 10 to 30 companies. 3. Dividend-paying stocks. 4. Moderate PE ratios. 5. Avoid speculative stocks. Example: Company X, large, stable, PE 15, consistent dividend right-pointing arrow defensive investor invests. Company Y, small, volatile, PE 35, high debt right-pointing arrow only for aggressive investors. Golden advice. Simplicity and discipline are the biggest strengths of defensive investors. Chapter 15. Stock selection for the enterprising investor. Friends, Graham explains how an enterprising, active investor should select stocks. Enterprising investor mindset. Goal: earn better returns by doing research and taking calculated risks. Stock selection rules. 1. Undervalued companies with strong fundamentals. 2. Special situations like mergers, restructuring, asset sales. 3. Small and medium companies, often overlooked. 4. Cyclical stocks with timed investment. 5. Active monitoring of market news, earnings reports, and fundamentals. Example: Company A stock drops to 60 rupees, fundamentals strong. Defensive investor may ignore. Enterprising investor buys and later sells at 100 rupees right, pointing arrow high returns. Golden advice. Take calculated risks. Research and analysis are key. Chapter 16. Convertible issues and warrants. Friends, Graham introduces advanced tools, convertible securities and warrants. Convertible securities, bonds or preferred stocks convertible into common stock. Start with fixed income, potential upside if stock rises. Example, 1,000 rupees bond right pointing arrow converts to 1,500 rupees, stock right pointing arrow higher return. Warrants, options allowing purchase of stock at a set price in the future. High risk, high reward, timing is key. Graham's warning, complex and risky, many invest without full understanding. Not understanding the fundamentals can make these expensive mistakes. Practical advice. Convertibles, only strong companies, consider interest plus stock potential. Warrants, long-term strategy, limited allocation, risk management, small portion of portfolio. Key takeaway, profitable only if investor understands complexities and risks. Chapter 17. 4 extremely instructive case histories. Friends, Graham presents 4 real-life company case studies teaching why some investments succeed and others fail. Purpose of case histories. Practical examples teach. Correct analysis. Spot market mistakes. Identify risk and opportunity. 4 case studies. 1. Strong company right pointing arrow stable earnings/dividends, consistent returns. 2. Cyclical company right pointing arrow economy dependent performance, patience required. 3. Speculative/overvalued right pointing arrow short-term profit, long-term loss. 4. Declining/neglected right pointing arrow weak fundamentals, high debt, uninformed investors lose. Key lessons. Research matters. Focus long-term. Maintain margin of safety. Diversify investments. Graham's golden advice. Investors who focus on fundamentals and logic succeed. Those who follow emotion/speculation fail. So friends, real-life examples strengthen investor thinking. If we learn so much from these case studies, is there a universal strategy that provides safe returns in every company and market? The next chapter answers this question. Chapter 18. A comparison of 8 pairs of companies. Friends, in this chapter, Benjamin Graham presents a comparative analysis of 8 real pairs of companies to explain the principles from the previous chapters in a more practical way. Here, we learn how proper comparison can lead to the right investment decision. Why comparison is important. Graham says, relying on the performance of a single company to make a decision is risky. Comparative analysis helps you understand which company is better and which is overvalued. 8 pairs of companies, stable versus volatile companies. Stable company, consistent earnings and low debt. Volatile company, sometimes gives good returns but is risky. Large versus small companies. Large companies, established, safer, moderate growth. Small companies, high growth potential but high risk. Cyclical versus non-cyclical companies. Cyclical, performance changes with economic cycles. Non-cyclical, demand is always stable. Safe investment. Dividend paying versus non-dividend companies. Dividend companies, regular income plus signals strong fundamentals. Non-dividend, riskier, depends only on price appreciation. Other pairs, 5 to 8. Asset heavy versus asset light. High debt versus low debt. Growth-oriented versus value-oriented. Popular versus neglected. From these comparisons, Graham explains that investors should consider not just market price, but also company fundamentals and relative value. Key takeaways. Comparison simplifies decision-making. Choosing the right option between 2 companies becomes easier. Look beyond price. Don't be influenced by popularity or hype. Understand risk and reward. Always maintain a long-term perspective. Margin of safety. Always remember this most important principle. Graham's golden advice. Investment should always be based on logic and analysis. The investor who performs comparative studies is the one who succeeds in the long run. So friends, from this chapter it is clear that rather than looking at a single company, comparative analysis helps in making correct and safe investment decisions. If comparative analysis and case studies are so helpful, is there a way to take an overview of the entire market, invest only in select companies, and almost eliminate risk? The next chapter, Chapter 19, will answer this question. Chapter 19. Shareholders and Management. Friends, in this chapter, Benjamin Graham explains how the relationship between a company's management and its shareholders is important for investors. Because the success of any investment depends not only on numbers, but also on the leadership of the company. Role of management. Graham says, strong management equals strong company. Management's job is to allocate resources properly, control debt and expenses, and prioritize the interests of shareholders. Poor management can manipulate financials or make risky decisions. Shareholder vigilance. Investors should not rely solely on stock price. Graham suggests that shareholders should understand their rights and the company's policies. Pay attention to annual reports, board decisions, and dividend policies. Warning signs of bad management. 1. Excessive debt without a clear plan. 2. Aggressive accounting to inflate profits. 3. Frequent changes in leadership without reason. 4. Ignoring long-term stability for short-term gains. If these signs are visible, investors should be cautious. Ideal relationship. Transparent management plus informed shareholders equals long-term success. Graham says shareholders' job is not just to invest, but also to stay aware to protect their investments. Key takeaways. Pay attention to the integrity and competence of management. Shareholder vigilance can reduce risk. Long-term focus and discipline will keep investments secure. So friends, it is clear from this chapter that a strong and transparent management system is as important for investors as strong financials. If the management and shareholder relationship is so important, are there indicators to identify beforehand which company is trustworthy in the long term? The next and final chapter, Chapter 20, will answer this question. Chapter 20, Margin of Safety as the central concept of investment. Friends, in his final chapter, Benjamin Graham explains the most important principle of investing, the margin of safety. This is a concept every successful investor should understand. What is margin of safety? Margin of safety means that your investment should have a cushion to protect you from unexpected losses. In other words, always invest at a conservative valuation and low-risk price. Example, if a company's intrinsic value is $100 and you buy the stock at $70, your $30 is your margin of safety. This reduces your loss in case of market fluctuations or an economic downturn. Graham's golden principle. Price is never 100% predictable. Markets can be irrational, and stocks can appear overvalued or undervalued. Therefore, always adopt conservative estimates and a safety margin. In investing, safety is more important than profits. Margin of safety is the real shield. Practical application. 1. Defensive investor. Invest in large, stable companies. Moderate returns, low risk, high margin of safety. 2. Enterprising investor. Invest in undervalued stocks or special situations. Aggressive but calculated approach. 3. Focus on intrinsic value. Understand the difference between market price and intrinsic value. Always choose undervalued opportunities. Key takeaways. Margin of safety equals the key to success in investing. Conservative, disciplined, and logical investing builds long-term wealth. The easiest way to reduce risk is to invest safely and wisely. So friends, this was Benjamin Graham's ultimate advice: safety first, profits later. By following this principle, you can become a successful long-term investor in the market. Final thought. Are you always keeping a margin of safety in your investments, or are you increasing your risk chasing short-term gains? Remember, this mindset will make you a successful and safe investor. So friends, this was Benjamin Graham's timeless wisdom, the intelligent investor. We learned how any investor can protect and grow their money by adopting proper analysis, a disciplined approach, and margin of safety. Remember, don't panic over short-term market fluctuations. Always prioritize fundamentals, research, and logic. Conservative and calculated investing builds long-term wealth. If you liked this video, make sure to like and share, and subscribe to Finance Reads to get more financial wisdom and book summaries. And yes, comment below to tell us which investment strategy you want to learn about next: defensive, enterprising, or a combination of both. Keep learning with Finance Reads, stay smart, and become a wise investor.